Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's do one thing. Let's invite Gaurav Mehta of Ambit Asset Management, who now joins us on the show. Gaurav, hi, good afternoon. Been a bit of a bipolar market, this one. The Nifty and the Bank Nifty, if you take a look at them, they are pretty close to the highs. But if you take a look at the mid caps, the broader market, on an average, stocks are down 25-30%, and which is normal. In bull markets, we've seen that happen. But your thoughts on what's happening right now?
Right. So I think what you're seeing in the markets is that after the last 3-4 years of small cap outperformance, there was a bit of euphoria. There was a bit of sort of optimism that was being baked into small cap prices, and which is why if you look at the kind of run that you had in 2017, it was pretty indiscriminate. Lots of relatively poor quality companies were also flying through the roof. So I think what you've seen over the last 4-5 months is a natural correction of that excess that was being built of the euphoric phase. And the news flow that you've seen in the last few weeks with respect to sort of corporate governance and accounting and sort of auditor resignations, etc. I think all of that does suggest that froth is now getting cleaned up. You're seeing panic selling on the back of such news, which again suggests that things are becoming more rational now. So I think going forward, things will again revert back to how earnings pan out. I think the valuation froth, the sort of overbought conditions that prevailed by December 2017, I think most of that have corrected, and now we are at much saner levels to begin with.
Gaurav, hi. The good and clean philosophy that you guys follow, I guess the whole market is gravitating towards that because it's simply sticking to quality irrespective of the cost now. But when you're looking at high quality stocks that are also offering you good growth, I mean, consumer is a name that instantly comes to mind. Any fresh ideas that sort of came across your way? I believe you, for instance, are increasing positions on some of the room cooler companies, room cooler air conditioning sort of companies.
Right. So I think, broadly for us, consumption is again two very distinct baskets, staples as well as discretionary. So I think we've in general been preferring discretionary consumption over staple consumption. Obviously, the reasons are twofold. A, as the economy graduates from, whatever $1,700 per capita GDP to a much higher per capita GDP, you will see a disproportionate amount of non-linearity in discretionary consumption versus staple consumption, which is going to only grow linearly. So from that point of view, I think discretionary consumption is something that we've been anyways favoring. And at these valuations, we don't see how staple companies can continue to deliver the kind of outsized returns that they have over the last few years. So from that point of view, yes, discretionary consumption is something that we've been heavy on, and we've sort of continued to look at leading companies from that space, and especially the kind of companies where you have still a significant portion of unorganized players, and with the advent of GST and with in general sort of aspirational consumption picking up over time, you will see that shift from unorganized to organized play out. So I think the category that you mentioned is one that clearly stands out on that front, and yes, we've been increasing exposure there.
Okay, by the way, the Nifty Pharma is down about 1% this week. Gaurav, is the top-down pharma move now sort of in the last leg? Is it going to be about individual stocks, or you think the sectoral move also has some legs?
I mean, our view is that with the kind of pessimism that was baked into pharma stock prices, I think this move is just about the beginning of a period of normalization for pharma stocks. I think fundamentally things are improving. The price pressure in the US is now sort of coming to some sort of a sanity. So we don't expect more than a single-digit price decline from here on. More importantly, you're now seeing an increased pace of US FDA approvals. Plants are getting cleared, more products are being approved. So I think that in turn should be sufficient to offset the pricing pressure that you're seeing in the base portfolio. So, we don't think that FY19 will be that year where you see a significant recovery in pharma stock earnings, but FY19 will at least be better than FY18, and FY20 is where you should see a very strong recovery come through in terms of earnings. But valuations being where they are, I think you still have significant room for re-rating on pharma names. So anyone who has a 12 to 24 months horizon, I think pharma is still a very attractive bet. So I think, this move is just about beginning rather than coming to an end.
Sure. Where does that leave IT then? Gaurav, because I mean, IT was the earlier play, recovery from the US side, and plus, of course, the currency tailwind. Is there more to go on the IT rally, or do you think that pharma is now going to kind of dominate mindspace?
I think from a macro point of view, we do think that a large part of the undervaluation that you'd seen in IT 6 months ago, that's broadly corrected itself, that's broadly normalized. So I think on a top-down basis, IT is a sector that in our view should be market performer. There are still tailwinds with respect to a recovering global economy. There are tailwinds coming from sort of improved capital allocation as you respect to increased buybacks, etc. So that should continue to support that sector. But I think, a large part of the juice of the rally is already behind us. And as a result, we would think that you need to be much more stock specific in IT now, rather than take a macro trade that has worked for the last 6 odd months.
So, Gaurav, is there a case for this market having made a high for this year, or you think it can be taken out? Because in the second half, we have some headwinds. Like the big state elections, there's of course this whole trade war and surge in crude prices, and of course there's a bit of a risk of early general elections as well. Or you think that this market has now priced most of those risks in?
Right, so clearly there are lots of domestic factors to watch out for, but I think what's happened over the last 5-6 months is more global in nature rather than just being local. So, if you look at the last 5 months, the US dollar has been strengthening. It's been strengthening because obviously there is differential monetary policy in US versus the rest of the world. And that strengthening US dollar in turn has meant two things. A, commodities in general have seen a bit of a pressure, and B, and more importantly, emerging markets as a basket has seen a lot of pressure over the last 5 months. Within that, I think India has stood out. India has now started outperforming the other emerging market peers. And I think that outperformance is driven by two things. A, commodities are softer, and B, there is that local support of domestic inflows that's supporting the market. So, in a way, this US dollar strengthening, if it continues, will be positive for us because commodity inflation will be under check. And on top of that, you're already seeing a sign of domestic economic recovery materializing. So this combination where a lot of froth has been taken out thanks to the correction of the last few months, the domestic economy is picking up, and thanks to a strengthening US dollar, commodity inflation is in check. So I think this combination is very potent for corporate earnings, and we expect that corporate earnings should revive very shortly, and as and when that happens, I think the market should continue with its uptrend. So it's difficult to say whether you've already put in a top or not, but I think from a 12 months point of view, in spite of all the uncertainties that will come in the short term, I think markets will gravitate towards what corporate earnings do, and we think that corporate earnings should be pretty healthy. So I think a 12-month investor should still invest in Indian equities. We should still expect double-digit returns from the index from the current levels.
It's absolute dead heat on the screen. I mean, there's just absolutely no movement. 10,740, 42, 43. That's all that's going on. Mid-cap index is still nursing losses of over 100 points. That is the situation. Gaurav, then final question. We're halfway down this calendar year. If I look at the next half, which sector do you think is going to be the star of second half calendar year 18?
Right. So I think, so far you've already seen a very strong pickup in urban consumption. I think with this being an election year, and hopefully with monsoons going to pan out in a normal fashion, you should see rural recovery also come through, especially rural consumption. And I think to play that rural consumption theme, obviously staples should do well in terms of reported earnings, but I think most of those earnings are already discounted in valuations. So I think the best way to play this rural recovery will be through SUVs, tractors, two-wheelers, agrochemicals, agricultural pipes, irrigation pipes, etc. So I think rural consumption should be the theme that should dominate second half of this year.
All right, Gaurav, always good talking to you. Thanks a lot for taking time out for us.